folks. I'm Sam Chandan, the Silverstein Chair and Dean of the Schack Institute of Real Estate. Thanks so much for joining us for week 5 of the summer 2020 REIT Leadership Series. It's a program that I have the privilege of co-hosting with my two colleagues, Panovka and Adam Emmerich, both at Wachtell Lipton, the co-chairs of the REIT M&A practice at Wachtell, both also members of our REIT Center board, and Robin a member of Schack's advisory board, as well as my good friend and colleague Scott Robison, a faculty member here at the Schack Institute and the director of the NYU REIT Center. Before we proceed with the formalities of today's program, just a very special announcement. And I hope many of you will have seen the press release that we put out yesterday. If not, it's also on Schack's website. But you can see on the screen that we're joined by Dustin Jones. Any of you who may hail from Ithaca may recognize Dustin. Over the last 6 years, he has been the head of Cornell University's Baker program in real estate. And we are absolutely delighted at NYU that Dustin has joined us here in New York as of this week as the new academic director of U.S. graduate programs at the Schack Institute. So welcome, Dustin. We couldn't be more thrilled to have you here. Thanks. Excellent. So folks will have a chance to meet Dustin and interact with him a little bit more over the coming weeks and certainly in the fall semester. This series put on by the REIT Center and by Adam, Robin, and Scott has just been amazing. If you missed our kickoff with Sam Zell last month, or Hamid Moghadam, or Ron Havner, or any of our other guests, you can catch replays on Schack's YouTube site. That's just YouTube/NYU Schack, and I'll share that link and several others over the course of the next hour in the chat feature of Zoom. Please don't forget to join us next week. We have Debbie Cafaro joining us. Debbie, of course, is Chairman and CEO of Ventas, and also plays a very broad role in helping to guide and lead the industry, given her particular leadership role at the Real Estate Roundtable as well, and advocating for the industry in Capitol Hill and in Washington. In a couple of weeks, we'll also be announcing our programming for the fall, and we have some really exciting things coming up over the next couple of months. A special thank you and a quick shout out to Monmouth Real Estate Investment Corporation. Monmouth is the sponsor of the series this summer. Throughout the year, is a major supporter of the Schack Institute, in particular of our scholarship programs, both merit-based, but also need-based financial aid, which of course over the last few months has been even more important for our students than has been the case ever before. But without further ado, Adam is going to give Sherry a proper introduction. Very briefly, Sherry has been at BlackRock since 2012. She joined the firm as a co-global chief investment officer and chair of the Global Real Estate Investment Committee. She has been a great friend of the Schack Institute, joining us regularly for the REIT Symposium each year, which of course now is in its 25th year, and speaking also at the Women's Leadership Conference, one of the largest events of its kind in our industry. A reminder to everyone over the course of the next hour, please do use the Q&A feature that Zoom has available. And if you see a question you like and want to make sure that we answer, hit that upvote button. The questions that get the largest number of upvotes are going to be the ones that we focus on when Scott and I come back at around 1:10, 1:15 Eastern time to join Adam and Sherry for Q&A. But with that, let me pass it off to Adam to take us away.
I'm not sure that I'm really capable of giving a more complete introduction than the one that Sam gave. I mean, you are a rock star. You've been a pillar of the REIT investing world, certainly during your nearly a decade at BlackRock, but you have a long history before that of having been involved as an active manager in other real estate investment managers. And so you really, there's nothing I can add to saying that you're a rock star. And you've been a great friend to Robin and my efforts at NYU. And a faithful panelist, and always one who gets fabulous reviews. And I'm sure today we'll have an interesting conversation. We'll talk for about 40, 45 minutes, and we'll then turn to the questions that will accumulate, may already be accumulating, and be voted on. This is an incredibly broad topic. We're incredibly lucky to have you with us today. So we'll do our best to cover a lot of ground, and I'm sure we could talk for 2 or 3 hours and not cover everything that people would love to hear from you about investing in REIT and real estate today. But we'll do our best. So again, thank you for being with us today. Super appreciated. Look, as much as anybody in the world, I think, with your position at BlackRock, you're seeing what's going on with global real estate equities around the world. Just to ask a very general question to lead things off, can you give us a little bit of a sense of what you're seeing around the world in terms of impact and recovery in REIT and real estate equity markets?
Sure, and thank you for having me. I'm delighted to be here. And Adam, you don't disappoint. Your background is very lawyerly with all those books in the background.
I'll try to keep it not too boring when we chat.
There you go. So the big picture is that the combined fiscal and monetary stimulus in the US and Europe have been more than enough to cover the size of the initial shock from COVID-19. That said, we're relatively more positive on Europe, mostly galvanized by policy response, and more cautious on the US as the fiscal measures are expiring and not yet renewed, i.e. enhanced unemployment insurance. But the stock market is not the economy. Let's keep that in mind whenever we think about the fact that because the US monetary policy has been so strong, and in fact dwarfs other countries' monetary response relative to GDP, the US stock market is outperforming the other countries' stock markets. And so the recovery in the stock market isn't uniform globally. It's dominated also within the US by the large cap tech stocks that are becoming a bigger and bigger part of the indices. That's something we can talk about more as the conversation progresses. But just like in real estate, we are definitely seeing a variety of responses depending upon where you are, how much of your life is involved in the interaction of people versus how much can be driven by technology. And so we see that broadly, and we see it within real estate. One area that we'll want to talk about in a little more depth later also are the emerging markets ex-China. And there's a lot of real worry there as the slope of the rising COVID cases is quite steep and the healthcare infrastructure to manage it isn't there. So we're going to see greater bifurcation globally among emerging and developed countries.
Okay, that's fascinating. Can I just drill down for a second, if you have, if it's okay, on the fiscal policy response? Are there particular sectors where the lack of ongoing fiscal policy support for the U.S. economy is going to hit hardest, or that are the most disconnected, if you will, because of the monetary policy response and the elevated stock market levels? Are those the stocks that have been, is it correlated? I mean, you see stocks obviously in sectors that are heavily dependent on movement and consumer spending and so forth, maybe hit the most, but are those actually overvalued because of the lack of fiscal policy response?
Well, one thing that's been different about this downturn and the government's response is that it has put money directly in the hands of the businesses and the people that need it. Mm-hmm. So that's part of why we are seeing an immediate, although multi-staged recovery that we didn't see in 2008. We saw there a very deep V, and theoretically, we will see less long-term scarring from this crisis because of the fiscal response. That said, clearly, people in the lower economic demographic strata are harder hit, And much of that spending is non-discretionary spending. And so that is, where you're going to see in the real estate space, we're going to see the most pressure, right? You're going to have people that aren't able to spend the way that they're accustomed to spending. And we see that most pronounced in the retail sector. But separate from that is, the work from home phenomena. This is really driving a huge change in the lodging sector, the transportation sectors. It's going to change the use of public transportation and put people back in their cars. People are going to be hesitant to use public transportation even when they do return to work. So this is a downturn unlike any other that we've had because it's health driven, but it has so many ramifications about the congregation of people that we're going to continue to see suppressed corporate travel. Just like we're doing this virtually, I don't know about you, but every speaking engagement that I've been invited to is now virtual through the end of 2020.
Yep.
And even now into the first quarter and second quarter of 2021. So until there's a vaccine, I honestly don't think any of my clients want to talk to me in person. They are perfectly happy with Zoom. So that is going to have, a long-term impact on the lodging sector. We've seen, and we can get into this again in greater detail, but really that is just one example. Retail is one example of the acceleration of existing trends that COVID is driving, right? We're going to see things that were already happening, whether that is populism, deglobalization. COVID-19 is really magnifying the impact of these trends.
In terms of deglobalization, any particular sectors in the real estate world? Is that vacation? Is that hotel? Is there what else is there that's going to be hit as a result of that closing up of borders and lack of transportation and travel?
Right. So we also cover, in addition to real estate securities, we cover infrastructure securities, and so airports are clearly impacted by that. Any country that is dependent upon tourism, clearly impacted by that. That also then has ripples into retail as well. But even from a logistics perspective, which clearly logistics has actually been a beneficiary of stay at home, right? Everybody's ordering more online.
Sure.
Even people who refused to buy online previously are now doing it. So when you start to think about supply chain and the deglobalization of that, yes, it's going to be more expensive to bring it back onshore.
Right.
But yet it's going to happen for the security of the supply chain, as well as the trade tensions between China and the US. Now I've seen estimates that it could be as high as $1 trillion to bring all of America's, back onshore, our supply chains back onshore. But that even if you amortize that over a 5-year period, that it's quite doable relative to the risks that the CEOs see at this point.
Shift gears for a second, if it's okay, to talk about the scale that you deploy as BlackRock. I mean, it's immense, obviously, and it's impressive. Has that been helpful to you in taking advantage of opportunities to have so many touch points all around the globe? Has it made it difficult to take advantage of opportunities in any way? Talk a little bit about the scale of the enterprise and the investment portfolio that you manage.
Right. I think everyone knows that BlackRock is big, but I don't know that everyone realizes that it's $7 trillion of AUM. So that's bigger than the GDP of most countries. It's huge. And when you think about that, in this crisis in particular, that scale has absolutely been an advantage. Our performance, both through the downturn and then in this, bit of the recovery that we've experienced, has actually been shockingly strong. I think our results were up 21% in the second quarter. And so it's a direct result of a scaled business model that's supported by diverse global investment capabilities. I think it wouldn't be possible without the technology that we have. Most people I talk to, not just at BlackRock, but everyone, has been really shocked in a pleasant way about how well the work from home experiment has gone. But beyond the work from home, the ability to reach our clients through our technology and provide them the information that they want and need has been phenomenal and has really helped us. You know, everyone is reachable now, right? We're all at home. So, I mean, I've never had so much luck reaching clients ever because no one is traveling. When I call, they answer. And people feel isolated, so they're more than happy to talk, right? So I really think that ability to reach out and be the solution provider across all asset classes has been a huge benefit to BlackRock. So, you know, in the second quarter, I think we had 100 billion in net inflows. 10% of net inflows overall have been in ESG products. I know you wanted to talk about that later.
I do,
it's
absolutely.
alive and well. And, you know, I think we're seeing momentum in our alternative section as well, which is, you know, our real estate securities team sits within the alternative pillar of BlackRock. And we are absolutely seeing growing demand for that.
So let me just touch on those three things or two things that you mentioned in one sort of related thing, which is ESG, which may or may not be the same thing as stakeholder capitalism, and the alternative investment pillar. Just on the first two, tell us a little bit more about, you know, your own and the pillars and BlackRock's approach to ESG and to stakeholder capitalism. They both have become more important, and what does that mean to you as an investor?
Okay, when I think ESG, I really think I totally drank the BlackRock Kool-Aid on this. Okay, I think about the sustainability of the corporation, and that's not just an environmental topic; it is social and governance as well. I remember being on an REIT panel and being asked why, you know, REITs shouldn't increase leverage in this environment. You know, that it's so low cost. Why shouldn't we lever up? And the why is now, right? This is why. This is why everyone maintained those conservative balance sheets, and why those firms are going to survive this crisis and, in fact, be better for it. So when you think about the stakeholders, it's not just the shareholders, it's your tenants, your employees, your customers, and your shareholders. And it's really about listening to each of these shareholders, crafting a strategy that incorporates what they're telling you. Everyone wants to be heard. In fact, a lot of our issues in this world could be avoided if people just listened, right? So if you take that information, the companies that successfully create a strategy and articulate that strategy consistently across communication channels, those are the companies that will do well, particularly if they recognize the change that is going on in the world today, incorporate it, and adapt to the change. That's what people mean by resilience, right? Yes, a good balance sheet gives you resilience, but the ability to recognize change and adapt your behavior to it, that is resilience.
Got it. So in terms of how that gets played out for you as an investor, and you're involved, if I'm not mistaken, both in active real estate strategies and passive real estate strategies.
Well, actually, my team is really focused on active. I do sit on BlackRock's advisory board for its investment stewardship. And that group does all the proxy voting for the passive shares as well.
Right. Right.
So in that way, that advisory board sets the policies by which all those proxies are voted. And so I have a role there, but my day-to-day job is really about the
On the
active
active
management.
side.
Yeah.
So in terms of interacting with names that you invest in on ESG topics, is it both kind of a screen where you just have criteria of looking for resilient companies that get it, or is it also a function of engagement and talking to companies and saying, hey, we could invest more if you kind of were a little bit smarter about some of these things?
Okay, let's divide it into the two camps. The one camp for active,
Yeah.
we generally don't run screens. We think the right way to do it is to incorporate a company's ESG policies into the risk assessment
Mm-hmm.
of the company, and so that it impacts the security valuation.
Mm-hmm.
Okay, so that is a much more forward-looking rather than a backward-looking
Mm-hmm.
approach to ESG. And the way that we gather that information is, of course, our analysts are out, reading sustainability reports and talking to the management teams, but we also interact with this investment stewardship team that is really in charge of the engagement with companies on a governance basis.
Mm-hmm.
Now, BlackRock has had over 2,000 engagements in 2019 alone. The staff has gone from less than 15 to 48 and is on its way to 60. Okay, so that team of people is out there actively engaging with the company management teams about ESG topics.
Mm-hmm.
Technology allows them to efficiently share that information across all of our active investors, as well as use it to vote the proxies for all of the companies
Right.
held in the passive. So it's a multi-front approach to gather this information, and the way that we use it is, in the active sense, really to develop our own ESG assessment in order to have it part of the security selection process.
Right. So it's interesting in a way, if I've got this right, in the passive side with the stewardship team, which is more and more, strong and focused and impressive, you're engaging with companies and kind of, in a way, maybe this is putting words in your mouth, but it's a question. So, almost coaching people and communicating with them, with the world and the market about, what you value as an institution, which is obviously very high profile and very, very notable. On the active side, people can take note of all that same information and make use of it, and they should be doing that. But effectively, you're communicating in a way less, and you're acting as an active investor has traditionally, making investment decisions based upon the world as it is. Is that fair?
Yes, and when you think about it, that's the fiduciary responsibility of
Very
each
logical, of
director.
course, absolutely.
Right, because the team voting the proxies is really representing investors invested in all of the stocks.
Yeah.
And our team is owning a very small select number of them. And so our job isn't really to communicate to all of the companies in the index what they should be doing. It's really to assess who's doing it the best.
Yeah. That's fascinating. And are you frustrated sometimes, in the sense, if you come across companies that seem to be great except for XYZ or ABC, and how often have you succeeded in kind of engaging with those companies to change, or is it really almost, in a way, more the traditional kind of Wall Street rule? It is what it is, and you decide based upon what it is.
No, I think that we have had success in getting companies to modify behavior.
Mm-hmm.
I think that there are certain companies that just won't change, right? And
Yep.
they are dinosaurs. And soon that will become evident, if it hasn't already. It really depends, though, and this is where I think there's a problem, right? And it's a problem I don't have an answer. The reporting responsibility is expensive. So the data is becoming more and more available. Investors are becoming more and more articulate about what they want to see, right?
Yeah.
And yet, for smaller cap companies, the ability to obtain that information, it's too expensive relative to their size.
Yeah.
And so those companies with scale have an advantage. I mean, they have an advantage in many ways, right? They generally have a lower cost of debt, they can get an investment grade rating, et cetera. But that size advantage is also here.
Right, right. I mean, one of the things we started off as Sam mentioned, this series with Sam Zell, and Sam has been a part of our REIT M&A conference for a long time. It would have been the 25th anniversary this year, which we'll hopefully have a chance to celebrate in person at some point. As much as we're enjoying these Zooms, and as convenient as it is for all of us to be working from home, but Sam has been preaching this gospel for a long time about the reduction in the number of REITs and the champions in each field, and obviously we've seen some evidence of that over the modern REIT era, and we've seen obviously a huge reduction separately in the number of U.S. public companies. Are those phenomena, I mean, worrisome in one sense, the reduction in the number of companies, or is it all to the good? Because it is kind of a fulfillment of Sam's idea that you don't need jillions of little 100 million or 500 million or even $1 billion market cap REITs that are all in the same sector. How do you think about what the sector looks like and where it's going?
I think it's shades of gray, right? So that long tail of tiny companies,
yeah,
that could go away, right? It's really not that
not relevant to you as an investor.
It's not relevant to me as an investor. It doesn't impact the actual total return of the index that much. And, the reality is there's a lot of G&A that's going to waste, right? So that part of the argument I buy. The part that we actually see, though, is there are medium and large cap companies that have been bought either by private equity or merged between two public companies. And, from a purely selfish perspective, the less of those you have, the harder it is to create alpha.
Right.
Now, that said, we actually have seen no atrophy in our alpha generation. And in fact, the volatility of COVID-19 has actually increased the alpha. We've seen twice as much alpha year to date as we normally see in an entire year.
It's amazing.
Yeah.
It's just amazing.
It is.
You've been on the right side of that. Someone else has suffered double negative alpha probably.
Potentially. Potentially. So.
In terms of, you talked about the inflows into BlackRock. I mean, where is money coming from that's seeking yield in real estate? I mean, do you see it as is there a lot of undeployed capital that you would expect to find its way into people earning that double alpha?
I think that liquid proxies for real assets, our long duration, the highly certain income, are going to continue to be in demand in a low yield world. The sources of that demand, when BlackRock does its annual investor survey, for the last few years, about 55% of investors say they're going to increase their allocation to real assets. Now, it takes time for them to do that, particularly on the private side, which means a liquid proxy for it in the form of listed real estate can be a very useful tool. I have to say, since March, the number of inbound calls inquiring about listed real estate and listed infra or combined product has increased pretty dramatically. And it's interesting that it's diversified by geography, entity, and the product type that they're interested in. So they may be interested in, a pure beat the index real estate securities product, or they may want something that is a little more sophisticated with a covered call overlay to generate higher income. So, but I'm definitely seeing higher demand in the last 4 months than I did in the prior 12.
Interesting. Interesting. In terms of listed versus real, I mean, do you have that discussion with a lot of people? Is it really a function of size? If you have, umpty billions, you can really get a diversified exposure to real assets on your own, even if it's entirely illiquid, but you have some degree of control or lack of expense that you get in a listed vehicle. Why is not listed the answer for nearly everybody?
Well, it's interesting. A number of Middle East sovereigns have come to BlackRock recently and said, we, for the first time, want to invest in listed real estate. Now, they have huge direct real estate programs, right?
Right.
And yet, they're making an entry in a big way, both in a passive and an active strategy. And so I think some of it is where we were and are in the cycle. So you're at a point, prior to COVID-19, people were starting to become concerned about committing to a 7 to 10 year type of an investment, knowing that you can get in and out of a listed investment relatively quickly is an advantage. Given COVID-19 and the fact that we're still trading at a discount now to direct property prices, that particularly right at the end of March and beginning of April, I was seeing a lot of people really interested in that discounted valuation.
Yeah.
Now, as we've come back some, that's abated, but certainly it's been replaced by people now saying, oh, the market's stable. I feel like I can, go risk on.
Yeah. Do you think that will lead to a supply infusion? Is there a pipeline that you're sort of seeing on a shadow or other basis? I mean, is there going to be a migration of more assets, including on the infrastructure side, into liquid publicly traded vehicles?
I certainly see increased demand, but I don't really think you're going to see, the massive inflows that, drive. I'm positive about our sector, but I don't think, and I'm positive also because of our valuations relative to broader equities. That monetary policy driving risk assets up is going to, inflate all boats. But I think there's concerns, and when you drill down into the different sectors within real estate, it's been a pretty logical response. It is logical that lodging and retail have sold off dramatically, and that data centers and cell towers and industrial have outperformed.
Right.
I think where people have the most question right now is the office space. There's so much that's unknown about when will we go back to work? Will they provide more space per person? Will we go to hot desking? There are too many unknowns for people to feel comfortable. And the office space is a relatively large sector, particularly when you look globally.
Yeah. In terms of all that alpha you've generated, are you contrarian in terms? I mean, I mean, certainly directionally, I'm sure that you're obviously right in terms of where demand for the product has been robust, like in logistics or cell towers, and where there's been, a huge fall off, like in lodging. But where do you think the market is the most wrong in terms of these product types?
Well, I just looked at this morning. 90% of our year-to-date alpha has been from stock selection, not sector selection. So it's not that we zeroed out retail and lodging and made a bunch of money that way. It was because within each sector we picked the right stocks.
And what's been the difference maker among the winners and the losers in the sectors? Is it sustainability?
I think that's part of the answer. So when we started this year, we were pretty conservatively conservatively positioned
Mm-hmm.
because we were viewing the world that there was slowing global growth and a lot of uncertainty geopolitically.
Mm-hmm.
So within sectors and across sectors, we were conservative. When the market tanked, that served us very well.
Mm-hmm.
And then we took risk on really very selectively, and as the market recovered, benefited from that.
Mm-hmm.
And so, you know, we've also always embraced the new real estate, right? So
Mm-hmm.
we've always embraced data centers, cell towers as part of the real estate world. It's not alternative anymore. It is real estate. And so I think our view on that and our understanding of the different companies and their business models, you know, data center companies have different business models and it
Sure,
matters.
of course, yeah.
So I think our ability to choose among those has really made a difference too.
Yeah, interesting. Talk a little bit about, you touched on it obviously in terms of the, among other things, the fiscal and the monetary response, but going back to the great financial crisis, have a lot of lessons from that crisis served you well, or has this been sort of sui generis and a completely different experience than that?
Well, I mean, the GFC was obviously driven by, you know, a financial crisis. This is a health crisis. There's very different drivers. The response this time has been unprecedented, right? We've never had such coordinated global monetary and fiscal immediate response,
Mm-hmm.
right? Think about how long it took for
Right.
the monetary policy after 2008, you know, let alone to have this within weeks, you know, stimulus checks and, you know, additional unemployment benefits happen
Mm-hmm.
immediately, let alone, you know, the PPP programs, right? I mean, that certainly made a huge difference in terms of, you know, getting people through this shock. So those issues and responses are very, very different. And I think you're going to see a difference also in the recovery, right? Because we're going to have this multi-stage recovery and it's going to come in fits and starts as we have recurrences of COVID cases increasing. And until we have a vaccine, and actually, even once we have one, it's how does it get out to 8 billion people, right?
Yeah, that's a lot of people.
It's a lot of people, right? When you think about that and you think about not just the developed countries, but then how do you get that access to the vaccine in emerging markets? And so that is going to take time and it's going to have, you know, that's why we talk about the recovery as kind of a Nike swoosh, that you're going to go down and then back up, but it's going to take a while to rejoin the trajectory. And so I think the two time periods are very different, and yet a lot of the lessons learned in 2008 and what we were talking about before about what makes a sustainable corporation,
Mm-hmm.
what is the right balance sheet, what is the right long-term perspective to have rather than focused on, you know, how do you just survive today?
Mm-hmm.
And so even in our underwriting, that was a lot of, in March, a lot of what we did was go back and look and say, okay, what's going to happen in the next 3 months? Who's going to make it? Who isn't?
Mm-hmm.
And those that make it, who are going to, you know, really grow from it and who are going to be permanently scarred? And I think you could take that analysis beyond the real estate world and apply it to all companies. And that's explaining part of why we have such a bifurcation in the broader indices of having, you know, these big tech companies continue to dominate and then this shrinking piece of underperforming companies.
I see Sam is back and we have a ton of questions from the audience, as you might expect. Let me just try and sneak in one last question, which I hope you don't mind. I kind of know you don't because I gave you a preview, but obviously one of the things that's been going on in the world that we're all acutely aware of is the Black Lives Matter movement, the moment that we're living in terms of having a long overdue discussion about systemic racism and opportunity and equality in the country and around the world. And obviously that doesn't exclude issues of opportunities for people of different genders. And you've obviously been a pioneer in a lot of ways in a world that still is far from gender equal and equitable. And I just wonder if you have some thoughts for other people about that topic, including younger people who are making their way into the world now, and whether you think things are getting better, or your thoughts on the subject generally.
Okay. So it is an overdue conversation, but on the continuum of discrimination, equal opportunity in the workplace, it pales in comparison to fearing for one's life, right? So I don't want to equate those two things, but they are absolutely related to the same systemic discrimination that we have in our country and around the world. So that said, I am hopeful and I have seen progress. I want to be an active part of the evolution, right? That's part of why the Dividends Through Diversity with NATE REIT and, Wharton Women's Leadership Initiative. I try to devote time to those because I do want to be a part of that. I think it will happen. And I think I have seen changes. I no longer have to worry about kind of blatant comments in the workplace. I mean, if you ask any woman my age, we could tell you what now are amusing stories. Back then were just horrific, right? Things that people would say to us. That doesn't happen today. It's unacceptable. But what does happen is the often used term of unconscious bias is oh so true. People naturally want to like people that are similar to them, right? So if you have a bunch of white men as the hiring decision makers, it shouldn't shock anyone that they like to hire other white men. So it's more insidious. It's hard in some ways. It's harder to identify and get rid of it. Now, my ask to everyone on this call is that when you hear yourself saying, oh, he would be a really good fit, stop yourself and say, is he a really good fit because he is a great thinker, he brings a diversity of perspective, he has a skill set nobody on the team has? Or is he a good fit because he's just like you? And if that's the case, then keep looking.
Has the ring of truth and experience. Well, we're all working on it now, but appreciate very much your efforts on this and those strong, clear, sensible words on the subject. Sam, I don't want to end up with no question time, and I know we had
we'll jump with you, Jerry. I appreciate your points on that. For folks who recall, just a moment ago, Sherry mentioned Dividends Through Diversity. It is an initiative of the National Association of Real Estate Investment Trusts, NAREIT, of which Sherry is co-chair. So in just a moment, I'll drop a link into the chat feature. If you're in the REIT space, this is absolutely an initiative to learn more about. It's really worthwhile, and there are opportunities for folks to get involved. I've had the opportunity to attend some of the Dividends Through Diversity gatherings myself. Sure, I want to come back to a point that you made right at the outset of the hour with regard to some of the fear, anxiety that folks are going to have in getting back onto public transportation, the desire to, or that sense that, in spite of our best efforts to control congestion, to put UV lights in place, that your car is going to be a safer way to get to work. How is that impacting your thinking about not sector exposure, but actually geographic exposure? In New York, we live in an entirely different world in terms of our dependence upon the public transportation infrastructure than is the case for a Dallas or a Philadelphia. What are your thoughts on how some of this might impact business resumption planning in terms of getting people back into work, and ultimately what the real estate equation looks like?
I think that's a really good point. You can already see it. So I was on our real asset call today, and already just globally looking at the BlackRock offices, you see people going back to work in our Greenwich office. And, my assistant was in on Monday, and she was the only person on the entire floor in our 40 East 52nd Street office in New York. And that's just indicative of what's happening around the world, right? London, hardly anybody's there. But if you go to the other offices in Europe that tend to be lower rise and less densely populated, there are people in the office. I think culturally, there's also a difference. So when you look at Hong Kong, people there have dealt with epidemics in the past, and they have quickly resumed going back to the office. Whereas here in the US, we don't do that, right? We're not getting on public transportation. No one is being expected to be back in the office yet. And so I do think this whole gateway phenomena that we've all kind of been, a proponent of in the past decade is one that is going to ebb, but it's going to be different across different cultures. And also land availability, right? So in the US, you have lots of options, and the more that companies allow people to work from home, you have even more flexibility. If you're in a Singapore or a Hong Kong, it's a totally different situation. And so I do think we have to be cognizant that gateway cities in some countries will remain gateway cities. I think there's a number of factors outside of the pandemic, including taxes, that are also at work on some of our gateway cities. And so, and you can see that also, just look at the apartment company results, right? People are making choices right now, and your short-term multifamily lease is a very quick way to measure that choice, right? Because people can't, the average lease is 9 months, and so you can quickly see a change in the occupancy levels that may take longer in other asset classes.
I'm going to pass it off to Scott in just 1 second for the next question, but a quick follow-up on a point you made. At our Urban Lab, one of the things that we're watching closely and are you're quite concerned about is your point about taxes and more broadly the fiscal health of different major cities around the United States in terms of their ability to continue providing public services, their ability to remain tax and service competitive for both businesses and residents. And as with so many other aspects of the crisis, cities already perhaps being challenged, and this having accelerated some of those challenges. For those of us who remember fiscal crises in New York or Philadelphia, these can have a real impact on on the competitiveness of cities. Is that an underpriced or underevaluated element of the real estate equation right now?
I don't know if it's underpriced. I mean, I think we're seeing it. If you look at the stock prices of the companies focused on the gateway cities, you can clearly see an impact to, San Francisco, New York-based companies. It's clear. So I don't know that it's underpriced, but I think it's not fully understood, and there's so many questions about it. And the fiscal health of the cities really is, it was a question before because of the change in the taxes, but now with COVID and the change in the tax base, it's going to be even more dramatic. And so I think it's only beginning to, people worry about it and it's reflected in the price, but I think we're only understanding the tip of the iceberg right now.
Scott?
Yep, you mentioned your alpha at the stock versus sector level. Congratulations on that. How does that inform your outlook for M&A? Do you see a lot of divergence at the company versus stock level, and therefore more M&A opportunities? And do we expect looking forward to the next year?
As always in REITs, there are a lot of, shall we call them, social issues that prevent what would otherwise be logical M&A. And I think that continues to be a barrier. But where there is a huge cost of capital difference, Certainly there are places where it's making more and more sense. But again, even when you look at a sector that is particularly beat up, it is hard even for the healthier company among that beat up sector to make any kind of large acquisition. And so, because their hands are tied in so many other ways. And so you could actually see those sectors be more of interest to private equity, who won't have the same type of constraints, and may have interest driven by this wall of capital that Adam mentioned, that just wants access to real assets. So I think you're going to see a mix. And always you'll see, some resistance by management teams because of the social issues.
Adam?
Makes sense.
And a question here that got a lot of votes is, you mentioned BlackRock's 7 trillion rather in AUM, and can you tell us a little bit how much of that is in real estate, and what's active versus passive?
So there is 200 billion in real estate securities owned by BlackRock, give or take. Our active team manages just over 5 billion. So that's there's different scale going on there.
Yeah.
But some of that passive money, or some of that 195 billion is passive in real estate indexed money. Some of it is part of, broader equity passive money. So, the Russell 2000,
Right.
for example.
Right.
Or it can also be money that is in our active equity strategies that are not real estate focused. And I would say probably the majority of that money is in passive between the REIT focused and the broader equity. But there is some portion of it that's in active equities that I can't quantify.
And it's pretty much all. You're not doing direct real estate asset investment in some part of the shop.
Yes, we are. Yes. So our platform, our real assets platform, is over $50 billion in total, of which about 20 billion is direct real estate.
And what sort of, those are large institutional clients, or?
For the most part, yes. There are some funds that, smaller investors can participate. But for the most part, you'll see separate accounts and then, funds that are generally regionally specific.
Got it. Hopefully that was a faithful rendition of the question. Sam, do you want to?
Yeah. So as abrupt and as deep as the downturn has been, it's been cushioned somewhat by the CARES Act interventions, whether it's the supplemental employment that have now run out, the stimulus or economic impact payment checks that were made early in the crisis, although it took some time for folks to receive those. There's some back and forth on the Hill now about what a follow-up will look like. At least in the interim, we've got this window of time where those supports have essentially evaporated, including the eviction moratoria protecting folks in properties with federally backed multifamily mortgages, without those broad supports, without sort of another round of PPP, right around the corner. Do we face a few more challenging weeks or months if we don't get another round of funding in place?
Absolutely. And it's one of my, when we talk about this multi-speed restart, tracking policy is a big part of that, and understanding whether there's going to be further cushion for households and businesses is a huge part of that. And so the disconnect, though, is that the stock market keeps going up because of all of the monetary policy, right?
Yeah.
And so, I think what that means is just greater volatility in the stock market and greater pain for people, right? These are people's lives that are being impacted. And so, I'm hopeful that we're going to continue to see relatively quick resolution, but we have no way of knowing. I don't have any clearer crystal ball than you.
Well, we are just about out of time. Sherry, on behalf of everyone at NYU and the Schack Institute, just want to thank you so much for taking the time to join us today, and for the so many ways in which you've supported Schack and our students over the years. It really means a lot to us. Adam, do you want to take us out?
Yep. Sherry, I just wanted to add, of course, my voice and Robin, who couldn't be here with us because of the blackout that he suffered right now through the storm today, and was super appreciated for you to join us today, and for all the things that Sam said that you've done with NYU and the Schack Institute over the years. It was a great hour, and as I said at the outset, we would have been thrilled to have 2 or 3, but it was a fabulous hour. We really appreciate it. Thank you so much.
Well, thank you for having me. And just one last word to the students on the call. I know this is a really tough time to be graduating. Your internships were canceled or made virtual, and you feel like a lot of what you counted on isn't there. But your generation is meant to be resilient. You have gone through 9/11. You survived that. You've watched your parents go through the GFC, and now you're witnessing the first pandemic in 100 years. And you are going to be fine. You're going to adapt, and you're going to be resilient. And I have faith in you, so stay strong. You're going to be okay.